Hedge funds. Glamorous risk takers are ticking time bombs. With over 28 trillion in exposure, they're not just some abstract Wall Street game. No, it's your bank deposits that pay the price if things go sideways. So you think you're feeling safe because of FDIC insurance? Think again. The FDIC only holds 1.17% of total insured deposits, which is peanuts in the face of a banking crisis. So you still think this won't impact you? You might want to rethink that. Let's talk about it. Thanks for taking time to connect with me. My name is Mike, and I make these short, deep dives to keep you informed, up to date, and one step ahead when it comes to the markets and how it might impact your money. And clearly, the interconnectedness of hedge funds and banks should concern you. So today, I'm going to highlight and answer 3 most important questions that you don't know yet, but yet you need to have answers for. And so 1, what are hedge funds and how do they operate? 2, why are mega banks heavily involved in hedge funds? And 3, how can you protect your savings from potential hedge fund collapses? So why are we talking about hedge funds? So you've probably heard the term thrown around on financial news or by your money-savvy friends. But what does that really mean for you and your savings? Well, here's the kicker. Hedge fund exposure in the United States has ballooned to $28 trillion. And if things go sideways, it's your bank deposits that could be caught in the fallout. You might not hear about the risk on the evening news, but make no mistake, the threat is real, and the institutions we're supposed to trust are knee-deep in it. So to really understand this, you have to know what hedge funds are really all about. So before we dive into the nitty-gritty, let's break down what a hedge fund actually is. So at its core, a hedge fund is a pool of private investments overseen by a manager who invests in a mix of assets, some risky and some not. The idea is to hedge bets by playing it safe on one side and going aggressive on the other side. So in theory, this limits the potential losses. But in reality, hedge funds are notorious for their high-risk plays in non-traditional assets, often borrowing colossal sums of money to do so. And here's where it gets alarming. In just 1 year, hedge fund exposure surged by 24.5%, jumping from 22.9 trillion to 28.5 trillion. That's an astronomical amount of leverage resting on the shoulders of institutions that are anything but stable. So who's on the hook if all goes wrong? You guessed it, us or you. And by us, I mean the people with deposits in banks that are intertwined with these hedge funds. And so the next question you might have is, how are the mega banks involved? So when you think of hedge funds, you can imagine wealthy investors taking on big risks. But there's another player in the dangerous game as well. So mega banks like Goldman Sachs, JP Morgan, and Morgan Stanley, these banks aren't just innocent bystanders. They're heavily invested in the system. See, they provide the leverage hedge funds need to make the risky bets through something called a prime brokerage. So essentially, they loan hedge funds money and securities, reaping profits from the arrangement. So now you might assume that these banks have robust safety nets in place. So after all, they are handling astronomical amounts of money, but that's wrong. These banks have been proven time and time again to prioritize profit over prudence. They're playing a high-stakes game that puts everyone at risk. The very same banks hold federally insured deposits, which are yours and mine. And if a hedge fund collapses, the bank will look to cover their losses using their insured deposits, potentially leaving us out in the cold. And so that begs the question, are we looking at another domino effect? So you think I'm exaggerating? Just look at Credit Suisse, one of the major banking failures of 2023. See, Credit Suisse was already wading through a liquidity crisis when one of its hedge fund clients, Archegos Capital, defaulted on billions in margin calls. This event triggered a domino effect that ultimately led to Credit Suisse's collapse. So this wasn't just an isolated incident. The U.S. banking system is so precariously footed, with many banks suffering from massive unrealized losses due to poor asset management. And yet, despite the warnings, Wall Street continues to push the envelope, putting more of our money on the line without facing any meaningful regulation. So this sounds familiar? It should, especially what happened leading up to the 2008 financial crisis. And so with all that said, the next obvious question is, so where are the regulators? Well, if you're wondering why regulators aren't stepping in to stop the madness, you're not alone. See, the Dodd-Frank Act passed in 2010. It was supposed to prevent another 2008 from happening. It seemed to regulate banks more tightly, ensuring that systemic risk didn't threaten the entire system. But here we are 14 years later, with much of Dodd-Frank gutted by Wall Street lobbying. Today is little more than a reporting tool with no teeth to actually enforce changes. And while the banks continue to push the limits, the people responsible for overseeing risky assets are quietly moving on to new roles in other companies, often in similar positions of influence. So it's a revolving door of accountability where the same individuals who failed before are allowed to keep playing the same games. But don't worry, they're always fine, of course. It's the rest of us who are left holding the bag. And so because the risk is on us, I'd assume that you'd imagine, is the FDIC safety net as secure as you think? And so you might be thinking, well, if my deposits are federally insured by the FDIC, why should I worry? So let's break this down a little bit because that's all an illusion. So the FDIC claims to insure bank accounts up to $250,000 per depositor, but they have a little dirty secret. They don't have nearly enough money to cover all the insured deposits. See, the deposit insurance fund only holds 1.17% of total insured deposits. So if multiple banks start to fail because of hedge fund exposure, there's simply no way they'll have enough to go around. And don't expect the government to step in to bailouts either. We saw what happened in 2008, a flood of bailouts that barely papered over the crisis, while regular people watch their purchasing power evaporate due to rampant government spending. You can't print your way out of a financial disaster this big without causing serious long-term consequences. And so at this point, the most important thing is, how can you really protect yourself? And so what do you do? So the key here is true diversification, not the illusion of it. If all your assets are tied up with the same interconnected financial system, you're not diversified at all. When one place goes down, everything could come crashing down with it. Real diversification means looking outside the traditional system into hard assets, alternative investments, and strategies that aren't dependent upon Wall Street. This is my opinion that your standard financial advisor likely isn't thinking about these things. But there are people out there who pay attention to it daily. And that's why I make these deep dive videos here, to give you an alternative perspective on things so that you can do your own homework, because you're responsible for your financial future, not some financial advisor or custodian at your brokerage account. It's you. You can't insure those things. That means the risk falls on you. And so my motto is always to get your weight up. If you understand what money is, which is gold and silver, and you realize what's happening with gold and silver right now, because literally, if you look at gold and silver as a measuring stick against fiat currencies, all fiat currencies are failing. And the most important one is the USD, or the Federal Reserve note, as I like to refer to it as. If you invert the price chart from USD to gold, you'll see the Federal Reserve note is down about 20% on the year. And so that means the Federal Reserve note, as well as every other fiat currency, is underperforming right now. And so if gold is a monetary constant, is what fluctuates, then right now the Federal Reserve note is experiencing some problems. So it's not something that is a good store of value at the end of the day. And so my motto is just to encourage people, educate people. And of course, in the description here, you can find out information on how I'm actively taking a hobby of collecting silver. That's something I enjoy doing, as well as an investment vehicle or a hedge against inflation, and then packaging it up in a way to help others in the form of a business with the silver team, was basically meant to help people automate their silver accumulation so that they can have fun stacking, dollar cost averaging the savings, and then help people do the same and reap the rewards of their labor. So anyway, if you guys are interested in finding out more, if you enjoy these type of short takes here, hit that thumbs up. Take a minute, leave a comment so I know that you guys are understanding what I'm putting together in these little short takes here. And also check out mysilverteam.com, links in the description, where you can find out more about a great opportunity that can help you diversify on all angles from what I just mentioned. But anyway, enjoy the rest of your day. If you want to see more of these little short takes, then you can click right here and take more of a deep dive on some other very important topics. And other than that, I'll catch you guys later.